Welcome to my last sampling video for this module. In this video, we're going to go over variable sampling. So as you may recall, we talked about attribute sampling in the last video, where we were looking at a specific characteristic, answering that yes or no question. In variable sampling, we are not looking to answer a yes or no question, but looking for a variance or looking for a dollar amount misstatement within those financial statements. So when we are looking um, we are doing accounts receivable confirmations and we get them back and we say, does the amount agree? Yes or no? And then how much is it off? So if we have a accounts receivable confirmation that comes in and it's off by $30,000 or $50,000, how bad is that? How off is that? And how comfortable and how close can we get to the financial statement dollar amount? And is that materially misstated? So ultimately, we're looking to know if those financial statements are materially misstated, and we're going to use variance or variable sampling to help us get comfortable and know how misstated we think some of those accounts might be. So the process is very similar to what we saw in the attribute sample. However, the terminology is a little bit different. We're going to have tolerable misstatement. This is that materiality amount that we determined early in the audit when we were thinking about planning. So when we said, as long as the financial statements aren't misstated by X, that's going to be our tolerable misstatement. So we're going to think about each of the various accounts, the transactions. What do we think is okay to be misstated? So remember, we're not looking to make sure the financial statements are perfect. We're looking to make sure that they're not materially misstated. Well, what does that material misstatement mean? How much is that we would need to be off? That's this idea behind tolerable misstatement, is we're trying to come up with a dollar amount that we think would be okay for those accounts to be misstated. That amount isn't going to mislead the users of the financial statements. Then we're going to calculate out something called the upper limit rate of misstatement. So we're going to take our sample, we're going to see how much known misstatement we have, how much error or variance we find in the sample, and then we're going to extrapolate that into the population. So let's say we find $50,000 worth of error in our accounts receivable confirmations. So maybe some payments were received that didn't get recorded until after the end of the year. So there was a timing error, so those were misstated. We're going to extrapolate that error onto the whole population and say, okay, well, if this happened once, what's the likelihood that it happened multiple times? And how bad do I think accounts receivable is misstated in total? So that's this upper limit rate of misstatement, where we took what we found in the sample, extrapolate that onto the population, and think about what do we think kind of the worst case scenario is for this particular account based on the results that we're seeing. When we compare that upper limit misstatement to our tolerable misstatement, we're going to come up to one of two conclusions. So our conclusion is either going to be the account balance is not misstated. So if our worst case scenario is that cash is misstated by $30,000, we were okay as long as cash wasn't misstated by $100,000, we're good. We could also say we think this particular account or balance is misstated. So we do our testing and we say, okay, it looks like cash might be, or accounts receivable, whatever the account might be, is misstated by 120,000, but we said materiality was 100,000, so this is misstated. If that's the case, it's going to require a couple of things. First, we might want to do a little bit more testing. So if we only looked at 20 confirmations for accounts receivable and there were 100,000 accounts, that's not going to be a very big sample to be able to make that conclusion. So we might want to look at more items and see if our opinion or that upper limit on misstatement changes if we choose a bigger sample size. So it might require us to do a little bit more testing. It also might require us to talk with our clients about adjustments to the financial statements. So they might have made mistakes, and those financial statements that they originally gave us might be misstated. So before we sign off on it, we'll give them a list of adjustments on things that need to be corrected before we can sign off on those financial statements. So if that's the case, we might have to have a discussion with our client about adjusting their financial statements based on the findings of this particular sample. We could have some things that go wrong here. So we have the risk again, type 1 and type 2 error, risk of incorrect acceptance. We choose a sample, everything looks good. We say thumbs up. We say the financial statements are not misstated. However, lurking in the population of items we didn't select, there were some errors that could lead to a material misstatement. So that's this risk of incorrect acceptance where we say everything is okay, we issue that clean opinion, but in fact, we probably should not have. Type 1 error. Type 2 error, the risk of incorrect rejection, is where we choose all the bad apples. We choose all the things that have problems, but that was not representative of the whole population. And if we looked at the population as a whole, we would see that it was not materially misstated. We just happened to choose the bad ones. So in this case, we are giving it a thumbs down instead of a thumbs up. So this could result in some unnecessary audit procedures. We're choosing another sample. We're looking, instead of looking at the 20 items, we're going to look at 120 items. So we're doing more work maybe than necessary to get comfortable with that account. We might require financial statement adjustments that were not necessary if that were the case as well. So that is variable sampling. And that concludes my videos for this module. Don't forget to complete your homework and quiz, and I will see you next week.